Why do value investors fall into value traps? Imagine finding a stock that looks like a bargain because its price is low compared to its earnings or book value. It seems like a golden opportunity, right? But sometimes, that cheap price hides serious problems. That is what leads investors to fall into what is called a value trap. A value trap happens when a stock appears undervalued based on traditional numbers, but the company's fundamentals tell a different story. The stock price stays low because the company faces ongoing issues that prevent it from recovering or growing. Many times, these issues include declining profits, poor management, or industry challenges. Investors might see a low price-to-earnings ratio or a low price-to-book ratio and think they found a deal. But if earnings are expected to drop further, or if the company's assets are overstated due to accounting tricks, the low valuation is misleading. It's like buying a car that looks cheap but keeps breaking down. You might think you're saving money, but the problems are hidden underneath. Another reason investors fall into these traps is ignoring the quality of the business. A company with weak cash flow, high debt, or inconsistent earnings is more likely to be a trap. If the company is losing market share or facing negative industry trends, the low price may reflect these risks. Sometimes external factors like new regulations or technological changes can damage the company's future prospects. These risks are often not obvious just by looking at the valuation ratios. Management plays a big role too. If leaders are making short-term decisions that boost profits temporarily or reward themselves while the company's health declines, the stock's low price is justified. Investors who only focus on numbers might overlook these warning signs. For adults planning long-term investments, avoiding these traps means doing more than just looking at ratios. It's important to analyze the company's fundamentals thoroughly. Checking if earnings are sustainable, industry conditions are favorable, and management is trustworthy helps. Using tools like examining political, economic, social, technological, environmental, and legal factors can reveal external threats. Practically, combining valuation metrics with quality indicators like return on equity, debt levels, and earnings consistency helps spot real value. Watching for declining institutional support from big investors can also signal trouble. Diversifying a portfolio reduces the impact if one stock turns out to be a trap. And being patient enough to exit a position if the company's problems worsen despite initial signs of value is smart. In short, falling into a value trap happens when investors relying too much on simple numbers without understanding the underlying risks. For those thinking long-term, careful analysis and a cautious approach are key to avoiding these pitfalls and building a resilient investment portfolio.